Capital asset pricing model, or as we people in the know say, CAPM. CAPM, that's how we would say that. So let's take a look at our stocks on some axes here. On the vertical axis, vertical means up and down, we have expected return, and on the horizontal axis we have standard deviation of returns, which is our measure of risk. And we have plotted on there slowpoke, which we said had an expected return of 10% and a standard deviation of 10.5%. That's how we got its location. And then we also have Supertech at an expected return of 15% and a standard deviation of returns at 24.2%. So that's how we got those two red dots. Now, does anyone have a guess what the square represents? Oh, you're close. Do you remember that portfolio we built with 60% Supertech and 40% Slowpoke? Yeah, we said the expected return of that thing was 13%, and the slide has an error on here. It shouldn't be 14.93, it should be 14.95. My guess is whatever grad student put together this picture rounded in their calculator. For shame. Okay, so it should be 14.95%, not 93%, but that is what's going on there. Now I want you to take a straight edge, or as straight as you can be with whatever you have at hand there, and draw a line on your slide between Slowpoke and Supertech. Go ahead and draw a straight line between Slowpoke and Supertech. Tell me, where does that box fall? Does it fall above the line or below the line? Above the line. Without the diversification benefit, that square would fall on the line. And so this is another way that we can visualize that diversification benefit. You're getting more return for the same risk, or less risk for the same return with the portfolio than you would be if there were no diversification benefit whatsoever. And it turns out we can go ahead and for every possible combination of Supertech and Slowpoke, we can actually generate an entire curve that shows what the risk and return of each of those portfolios would be. Now that square is still in the same place, Supertech is still in the same place, Slowpoke is still in the same place, but that curved line represents every possible combination. So 1% Supertech, 99% Slowpoke, 2% Supertech, 98% Slowpoke, and so forth, all the way until we get to the other end. Now, I want you to notice something about this curve. There is a part of this curve that we would not want to invest on. Do you see it? Oh, by the way, what do you think NV stands for? Minimum variance. Minimum variance portfolio. By the way, it's also the minimum standard deviation because that's the way math works. That is the safest possible portfolio you could have, composed of these two items. Now I want you to notice it's not composed of 100% of the safest stock, and that's because of this diversification benefit. So would we want to invest in 100% Slowpoke or portfolio number one? Which would you rather invest in, one or Slowpoke? Well, one gives you more return with less risk. That sounds amazing. But we could do even better. Would you rather invest at the minimum variance portfolio or one? The minimum variance portfolio. And so we would say basically that only crazy people would invest between Slowpoke and MV. Only crazy people would invest there. Now, so this whole curve would be the opportunity set, but between MV and Supertech would be the efficient set. So the whole curve is called the opportunity set. It's every possible thing you could do, But between MV and SuperTech would be the efficient set. That's the only places you should be investing. Okay, now in the absence of anything else, of knowing anything else, we would start to ask, why would someone choose, how would someone choose where they invest along this line? And the answer comes down to something called risk aversion. Risk aversion. Humans, if they're sane, don't like risk. We seek to minimize risk based on our risk aversion. Some people are more risk averse than others. I'm going to give an example here. Mr. Scarborough, did you tell us that you jumped out of an airplane? Yeah. Did you also tell us that you plan to do it again? Yeah. Okay, so we would say he's not very risk averse. And so if I were to guess where Mr. Scarborough was going to invest along this line, I would say he's going to be 100% SuperTech, because he's going to be trying to get all the return he possibly can get, and the risk really doesn't scare him all that much. Now, the question becomes, what determines our risk aversion? Any ideas? Oh, your age, very good. So when I'm like 18, 19 years old, my buddies are like, hey man, let's go jump out of an airplane. You can tell I hung out with stoners. Hey man, let's go jump out of an airplane. I'm like, how much? And they're like, $300. I'm like, whew, that was like $319, $90. No way, right? Even today I wouldn't pay that much to jump out of an airplane. And then they come back at age 25, I got a great job, I'm rolling in money. And they're like, hey man, we're gonna do the airplane thing. I'm like, are you freaking kidding me? I've got a great wife, I've got a great job, I've got a mortgage, right? 6 years made a huge amount of difference in my risk aversion. Now, I'm 50 years old now, and I gotta be careful for how I reach for the remote, right? Because I could hurt myself. You get to be my dad's age, and you're staring death in the face every time you get out of the bathtub, right? And so the risk aversion with age goes up. Does that make sense? Your risk aversion with age goes up. And so, let's talk about where my dad would be on this whole thing. My dad would be at the minimum variance portfolio because he's very risk averse. Where would I be? I would be somewhere in the middle between MV and SuperTech. And where would 18 or 19-year-old me be? Probably out there at SuperTech. Now, so we've discussed age. What else? I'll give you a hint. When you watch these stupid videos on YouTube of people doing stunts and winding up getting horribly injured, predominantly, are they male or female? Oh, there we go. Women tend to be more risk averse than men. Now, I'm not making this stuff up. You guys can see this all around you, right? And the answer could be evolutionary. Because, and then you think back to reproduction. How expensive is it for men to reproduce? And I'm not talking money. We're talking about what do you have to put into this whole undertaking, right? Flowers, dinner, that sort of thing. Now, what does the woman have to put into it?
9 months.
Oh my goodness, that's just the start, right? Because it's not like bear cubs where you could just, whoop, and they take, you're stuck with that person for years. And so if things are really kind of have a bigger impact on your life, aren't you going to be a little bit more circumspect about jumping into that situation? Absolutely. And so we see that females are typically more risk averse than males. We see that older people are typically more risk averse than younger people. And then, interestingly enough, people who live in areas where tropical disease is likely to kill them before they get old, do you think they're more or less risk averse?
Less.
Yeah, they're less, right? So I saw this, and I'm not saying TED Talks are cool, but I did see this one cool TED Talk. And it was this woman, she was talking about, she's like, people have been asking, why can't we get the message across in parts of Africa about HIV and how dangerous it is. And what she did, she figured out that the areas with the high HIV transmission rates were also the areas that had the high malaria rates. These people weren't expecting to live past 40 anyway. And so they're like, why should I care? Malaria's gonna kill me first. I'm not kidding.
No, that's true.
So, if, one more example and then we'll move on from this. Well, my dad's dad died when my dad's dad was 50. Just fell over from a stroke. So my dad always figured he had a relatively short clock. So what did my dad do? He joins the Navy, and then he goes to work in a dynamite plant. Right? The day he turned 51 was a huge surprise to him. And what do you think happened to his risk aversion? It went way down. He's like, oh crap, I might actually live to be old. He's 81 now. He's still hanging in there. Okay. Do you understand the relationship between risk aversion and where you would be on this whole thing? No, we're only part of the way there. So don't put too much thought into this right now, because we're going to show you that this is not how people actually invest. Now, what leads to that shape of that curve? And the answer is the correlation. The lower the correlation, the sharper that curve is. And in fact, when you get to a correlation of -1, you can have no risk whatsoever and have a positive expected return. And so you say, wait a minute, I'll just go out and get myself a boatload of two things that are perfectly negatively correlated, and I'll have all sorts of great returns and no risk. What's the fallacy with that argument? It doesn't exist. It doesn't exist. It's nirvana, but it doesn't exist. Most things are positively correlated, not perfectly positive, but most things are positively correlated. And I was giving this talk one time, and this guy in the back says, what about the S&P 500 and the anti-S&P 500? I even forget what the anti-S&P 500 is called, but basically, anytime the S&P 500 goes up one, the anti-S&P 500 goes down one. And so they just are mirror images. I'm like, well, they are both, they're negatively correlated, one. They are perfectly negatively correlated, but here's the problem. What is the expected return on the S&P 500? And the guy said, well, let's just say it's 12%. I said, okay. What is the expected return on the anti-S&P 500? If they move exactly opposite, what is it, Mr. Bohm? If this one's 12%, this one has to be minus 12%, right? I'm like, okay, so let's build you a portfolio out of half S&P 500, half anti-S&P 500. What's the expected return on the portfolio? He says, 0. I'm like, way to go. I could have just put my money all in a risk-free asset and had no risk and got a positive return. You're getting 0. And so we have to say, not only do they have to have perfect negative correlation, they also have to have both positive expected return. And you just don't find that. But it would be cool to have the lowest possible correlation I could get. That would give me the absolute most diversification benefit. Notice when correlation is 1, that thing is a straight line. You remember when I had you draw that line between Slowpoke and Supertech? That is what it would look like if they were perfectly positively correlated. Questions? Okay, so it's not just single asset or single stocks we could talk about. We could actually talk about country portfolios. And we could look at U.S. portfolio versus foreign. By the way, to an American, foreign means everything but the U.S., right? To Mr. Wong, it would mean something else. To Mr. Bohm, it would mean something else. But to American, foreign means everything except for the U.S., and that's what that portfolio is. Now, I want you to notice that the U.S. portfolio has lower return and lower risk. Why do you think that is? You don't even have to be a staunch patriot to get this one. So first of all, we know that growth and return and risk go together. Is the United States economy one of the fastest growing economies in the world? The answer is no. We're a mature economy, right? We're one of these developed countries. We've been around enough and we've built out our stuff and we're not growing leaps and bounds. But you look at some of the economies in the rest of the world. Let's take Rwanda, for example. The year I graduated college, Rwanda was in the news because they had this huge genocide where people were hacking people with machetes and throwing them over waterfalls. It was awful. Today, Rwanda is what's known as the Singapore of Africa. And so Rwanda is going to experience this amazing growth simply because they've moved to a better form of governance. They've decided to go with the rule of law and democracy and stop killing each other. And so as a result, what you're going to see there is some faster growth. But is there a risk? There's a risk that another dictator will take over. There's a risk that another civil war will break out. There's a risk that someone will take over and nationalize the assets of your firm. And so, yes, there's greater growth, there's greater return in those foreign markets, but there's also greater risk. And so if you were a very risk-averse person, you might say, well, I'm just going to invest in American stocks because they're the safest. Well, they are the safest, but a portfolio with a little bit of these risky foreign stocks sprinkled in is even safer. How can I prove it? Look down here at the 100% US, 0% foreign portfolio. How could I reduce my risk? Well, if I put in a little bit of foreign stock, I can move up there to the 90% US, 10% foreign, but I could do even better. I could go to 80-20 and hit the minimum variance portfolio. And this just freaks people out because here you are sprinkling this risky stuff into your safe breakfast cereal, and what are you coming up with? Something that's even safer and has more return. Does that make sense? So, you remember I told you in that previous slide that I said only idiots would be invested between the safe asset and that minimum variance portfolio? I was given this talk one day and I thought, oh man, I'm an idiot. I was an idiot because I was invested purely in S&P 500 at that time. What was I missing out on in my portfolio? Sprinkle a little of this risky foreign stuff in there to try to boost my returns and reduce my risk at the same time. So I went home that day afterwards and rebalanced my portfolio. And now every year on my birthday, TIAA Craft buys enough of one and sells enough of the other to rebalance my portfolio. So it's 80% US S&P 500 and 20% international large cap stuff. And so my investing strategy is very, very simple. I really don't have to do anything. I have most of it set on autopilot. And I'm not going to tell you my numbers here, but I'm doing okay, right? Okay. Now, where would Mr. Let's see, I just forgot your name, Lane Scarborough. Where would Mr. Scarborough be? 100% foreign. Where would my dad be? MV. And where would I be? Well, I guess I just told you I'm at 80-20. If I were a little less risk averse, maybe I'd be further up on that slope. Questions? Oh my. Okay, now you say, wait a minute. Yeah, it's 12:13. Let's just call it a day. How about that? So this is where we're going to start next time. We are going to finish chapter 11 next time. Remember, you got homework 5, discussion 5. And if you have any questions, please feel free to email me. So this is where we left off last time. Previously, we talked about how we could have two assets, and as long as they weren't perfectly positively correlated, we could hold them in the same portfolio and have what we call diversification benefit. What is the diversification benefit? That's when we get a lower portfolio standard deviation than just the weighted average standard deviations of the individual components. Remember, we're going to get the weighted average return on all those individual components, but we don't have to take the weighted average risk. And it turns out you can do this with more than just two assets. You can do it with every risky asset known to man. And that's what we're looking here. That blue field is every portfolio of risky assets you can possibly put together. And it doesn't say right here, but one of those portfolios is like 35% GE, 65%. So there are real portfolios in here. Okay, so what you need to understand though is even though everything in that blue area is possible, are they all good portfolios to invest in? So for example, tell me about portfolio W. Why would you not want to invest in portfolio W?
Lower returns.
Yeah, so I could go up to portfolio R and get higher returns for taking on the same amount of risk. Or I could go left over to that brown line and I could get the same return for less risk. Either way, W is suboptimal. And we could say the same things about 1, 2, and 3. You should not be invested in them. And so it turns out that the only place you should be invested here is along that brown line from MV to X. Remember we said previously that you don't invest down below MV because you have to be like crazy. But if you go from MV to X, we call that the efficient frontier. The efficient frontier. And just like our previous conversation, your choice of where to invest along that would be purely driven by your risk aversion. Let's see if you remember anything about risk aversion. Who's more likely to be risk averse? Young people, old people?
Young people.
Risk averse.
Oh,
Old people. Who's more likely to be risk averse, men or women? Women, right? Okay. So, and you could go through lots of different iterations there. Okay. By the way, my dad worked in a dynamite plant. I worked in a nuclear power plant. My grandfather both worked in the dynamite plants. I get a string of this lack of risk aversion, which probably means that I'll die in a stupid accident. Okay, back to the story. Now, we know where we want to invest along this line. And this was the thinking from, say, 1952 to 1964, roughly. And then if someone says, wait a minute, you don't just have the opportunity to invest in risky assets. You can also invest in the risk-free asset. And this is where we get to the introduction of the risk-free asset and the creation of something we call the capital market line. The capital market line. Basically, the idea is this. What is the standard deviation on the risk-free asset? By the way, it's risk-free. So the standard deviation is 0. Very good. What's the expected return on the risk-free asset? The risk-free rate. Now keep in mind that we don't truly have this theoretical risk-free asset. What we have is a 3-month treasury bill. And we said it's theoretically default risk-free and it's got very little price or interest rate risk. So that 3-month treasury bill is our stand-in for the risk-free asset. Now, any portfolio that is composed of both the risk-free asset and a risky portfolio has to lie on a line between that risk-free asset and the risky portfolio. And so what I want to do here is we're going to create a line that starts at that risk-free asset, and we're going to imagine we're putting a pin in over here to allow rotation. And we're going to rotate that line up to get it to have the steepest possible slope while still touching that field of risky portfolios. Now here's the reason we want to do that. Keep in mind that your expected return is on the vertical axis and your risk is on the horizontal axis. So we want to get absolutely as much return as we can for each unit of risk we take on. That's why we want that thing to be as steep as possible. but it still has to touch that field of risky assets or there isn't a possible portfolio for you to invest in on the risky end. And so what that leads to is that we end up with a portfolio that is tangent to that field of risky assets. Does anyone remember mathematically what tangent means? Or I should say geometrically. Yeah.
Touches at one time.
Yeah, it touches at exactly 1 point. So think about this. If you've got like a beach, or like a volleyball, and then you take a ruler and lay it on that volleyball, it's really only touching at 1 point. And so that's what we're doing here. We're taking something stiff and straight, just sitting it on something curved. It's going to touch at 1 point. And that 1 point is portfolio A. Portfolio A, that makes portfolio A a very special portfolio. It's known as the market portfolio. It's known as the market portfolio. Now, we don't know for sure, but we have a theory what's in this market portfolio. It is, are you ready to write? Mr. Rich, are you ready to write?
Yes.
Okay. It's every risky asset, every risky asset known to man, held in proportion to its importance in the world economy. So it's every risky asset known to man held in proportion to its importance in the overall world economy. I'll give you an example. Let's talk about a really big company, Apple. Apple at this point may have the highest market valuation of any company in the world. Now, is it going to be important to the overall world economy? Yes. It's going to have a much higher portfolio weight than, say, Target. Target, great company, but it's smaller. It's less important to the overall economy. It's going to have a smaller weight. Now let's take it even closer to home. What about O'Reilly Automotive? Do you guys know who they are? It's an auto parts store based right here in Springfield. They are smaller even than Target. So the weight on O'Reilly would be smaller than the weight on Target, would be smaller than the weight on Apple in this whole market portfolio. Now, are stocks the only risky assets out there? No. You may think of bonds as being fairly safe, but they are still risky assets. For instance, if interest rates shoot up, bond prices go down. Therefore, they are risky, and there's also default risk. And so, we're also going to have to include them when we put together this portfolio A. But so far, it sounds like stuff that we can actually get data on. But there's more than just that. There's also real estate in this portfolio of risky assets. I was giving this lecture to a class of China EMBAs yesterday, and I said, is real estate risky? And they said, no. And they said, well, the value of real estate in China has always gone up, up, up. I said that was true until recently. Chinese developers have started going bankrupt, and the money that people had put in China, what you do is you buy the house before they ever build it. And so when the builder goes out of business and keeps your money, is that risky? Oh, absolutely. So real estate is risky. I can prove it to you. I've lost $39,000 on a house that I lived in for 1 year. Huge drop, just over 1 year. So real estate, don't be fooled. Real estate is a risky investment. Now, here's the problem. Can you buy stock in my house? No. My wife and I are the sole owners of that house. We are the only ones. You guys don't have anything to do with it. My house, even if you couldn't buy it, if you knew what the value was doing on the house, you could still include it in that portfolio. However, there's only value data points on houses when they are sold. My house was last sold in 2007. I've been living in it for 15 years. The windows are starting to leak. Now, the problem here is we don't have a fresh reading on it. You say, what about Zillow? Zillow is a scientific wild-ass guess. It's not real, and I can prove it to you. If you look there, so there's Zillow, and then there's another one like Redfin or something like that. Go look there and see if the numbers match. I doubt they do. And it's because they're just using different algorithms to come up with their scientific wild-ass guess. And so, you cannot possibly create the market portfolio or recreate the market portfolio. So what do we do instead? Well, we use the S&P 500. The S&P 500. Now, why do we use the S&P 500? Number one, it's supposed to represent the overall United States economy. And the United States economy is the biggest one in the world. Number two, the stocks in the S&P 500 are held according to their market value. So, the biggest firms are represented more, the smallest firms are represented less. Now, how is that different from the Dow Jones Industrial Average? The Dow Jones Industrial Average only contains 30 stocks, and it's price weighted. And so a stock with a high stock price impacts the Dow Jones much more than one with a small stock price. Well, we know the stock price is just artificial, right? Because you could have the same firm, and if you divide it 10 ways or 10,000 ways, the stock price is going to be very different. And so it just irritates the snot out of me when people say, the market was down today. And I say, what do you mean? And I say, well, the Dow Jones was down. I'm like, that's not really a good indicator. What did the S&P 500 do? And they say, I don't know. So my point to you is this: the S&P 500 is a much better indicator of what's going on in the United States economy, in the market, because it is value weighted. Number one is value weighted, whereas the Dow Jones is price weighted. And the other thing is it contains 500 stocks. The Dow Jones only contains 30. Okay, so we are going to use the 3-month United States Treasury bill as our stand-in for the risk-free asset. We are going to use the S&P 500 as our stand-in for the market portfolio. And you're going to draw a line between those two things. And now that line is called the capital market line. And you should not be, according to this theory, should not be invested anywhere except along that line. Now let's take a look at what this line allows you to do. Notice that the slope of this line is exactly the same everywhere you go. Previously, when we were looking at the efficient frontier, when we moved away from MV, we got a lot of return for taking on slightly more risk. But as you get further and further out toward portfolio Y there, you would end up having to take more and more and more risk just to get the same extra unit of return. But now, it doesn't matter where we're at on this line, we can take on 1 unit of risk and get exactly the same amount of additional return. And so, looking between risk-free and A, let's say portfolio 4 there would be something that is 60% the risk-free asset, 40% this market portfolio or S&P 500. And so we understand how to invest along, going from risk-free up to A, but how do we get beyond A out to portfolio number 5? Keeping in mind that portfolio weights have to add to 100%. So far everything's been 0, 100, 1, 99, and so forth, right? How can we possibly get out to point number 5? I'll give you a hint. When you buy the risk-free asset, you are loaning money to someone. What's the opposite of loaning? Borrowing. So if we can borrow at the risk-free rate, now I can have 120% S&P 500, negative 20% risk-free asset, and it still adds to 100%. Now, here's the issue. You say, wait a minute, why would anyone loan to me at the risk-free rate? After all, I am not the United States government. And the answer comes from something called margin. Has anyone here ever invested on margin? Ms. Flowers, in your Robinhood account, ever invest on margin?
I think so.
You don't think so? Did you ever buy stock with borrowed money?
No.
Good for you. Okay, so here's the deal. Your broker will loan you money to buy more stock based on the stock that's currently in your portfolio being collateral for that loan. And the reason they can give you the risk-free rate for that is unless the stock just drops to 100 or drops 100% like instantly, they can usually stay out in front of it and sell your stock to pay off your debt before everything goes straight to hell. And so you may end up having absolutely nothing at the end, but the broker stands very little chance of losing money. Does that make sense? And it's not like they just instantly sell your stock. They call you up and they say, this is a margin call. And it's a call telling you you need to put more money into your account, and you say, I don't have any money. And they say, no problem. What do they start doing? Selling your stock until you get back into until your numbers look right to where they're not concerned you're gonna lose money for them. Okay, so we can borrow money with margin to get out there. Now, what kind of people would be at these different spots? Well, let's say my mom. My mom's probably over here all the way at the left-hand side with risk-free. My dad is at number 4. I'm at A. And then our parachutist is probably down there at number 5 because of his low levels of risk aversion. But now he doesn't have to pay this extraordinary penalty of all that extra risk he has to take on just to get a little extra return because that slope of that line is constant. And so this leads to something that we call the separation principle. And that is we can separate our choice of what we're going to buy from our risk aversion. It's really, we're only going to buy 2 assets. It's just a matter of deciding on the proportions based on your risk aversion. I no longer have to say, well, I only buy utility stocks because I'm risk averse. No, you buy, if you're risk averse, what you do is you put the S&P 500 in there at say 20%, you're 80% risk-free asset. And so you no longer have to go out and pick stocks. By the way, have I discussed that picking stocks is a losing game? Picking stocks is a losing game. And of course, there will always be someone that says, hey man, I made a killing on Tesla. I'm like, yeah, and someone else got their ass whooped on AMC, right? But you don't hear them talking about it. So who do you always hear about?
The gains.
The gains. You never hear the losers. I had this professor at Kent State. Guy got up there, he loved to talk about all these great trades that he'd made. And I raised my hand one time and I said, sir, if you've had so many great trades, why do you still bother to show up and talk to us? And he says, I only told you about the ones that did well. I didn't tell you about the unmitigated disasters. Your friends won't either. And it's like looking at Facebook or Instagram. Everybody else's life looks great, right? Do you think it's true? No. You got these people that are standing smiling and then next month they're getting a divorce. So it's the same thing when you talk to your friends about their stocks. They're not going to tell you about the toads, right? So picking stocks is a losing game. Don't believe it when your friends tell you otherwise. Questions? Let's talk about news and stock prices. What's been the big news thing here in the last week, internationally? Yeah, Russia invades Ukraine, right? What happened to stock prices? Right? News moves stock prices. So, let's talk about what would happen if there wasn't any news. We know that stocks have an expected positive return. And so let's assume the stock pays no dividend. We would just expect its value to go up by that expected return. That's it. It would just be very smooth, very straight. It would be risk-free. But it doesn't work that way because now we have news that changes how we think about these things. And it's so let's talk about how this Russian invasion of the Ukraine could change things. Number one, what's going to happen to natural gas prices? Got to go up, and here's why. Russia's the number one natural gas supplier to Europe. Europe is going to try to wean itself off of Russian natural gas. And so what do? They turn to their old buddy, the USA, who has lots of natural gas. We can liquefy it, put it on ships, send it to them, problem solved. Except for one thing. All that cheap natural gas we've been using here to heat our homes and run our power plants, now a lot of it's going to Europe. What's going to happen to prices of natural gas here? It's got to go up. And we see that Russia is a big source of crude oil. Well, that crude oil, you can get crude oil somewhere else, but people will be bidding up those supplies of non-Russian crude oil. Even though there hasn't been an embargo on Russian crude yet, Russian crude is still plummeting in value. And here's the reason why. People don't want to sign up to get a load of Russian crude 3 months from now, only to have 1 month from now an embargo put on their oil and not be able to receive that. And so that's what's going on there. What about the worldwide financial system? Well, they've cut Russia out of quite a bit of stuff, right? And so now there aren't nearly as many people bidding or involved in markets. And the smaller the market is, the lower the competition, the less the returns are going to be on these things. So long story short, a lot of this stuff is going to impact a lot of our lives. You may not even realize yet how this is going to impact your life. That's why that news of the invasion made stocks go down so much. Now, it's only the unexpected portion of news that moves stock prices because the expected portion is already priced in. Let me give you some examples. Let's say equity analysts, on average, assume that our shares are going to be earning $1 per share in the next quarter. And it comes time to report, and we report $1. That was expected news. The share price should not move at all. But what if we report $1.04? Well, that's $1 of expected news and positive 4 cents of unexpected news. What should happen to the stock price? Oh, come on, better than expected news? Yeah, it's got to go up, right? Or it should. Now, what if instead of $1, we report 96 cents? That's $1 of expected news and minus 0.04 of bad news. What's going to happen? It's going to go down. And in fact, we see what happens. It's called an asymmetric response. So, symmetric looks the same on both sides. Asymmetric looks different on the two sides. And we see that if they beat the earnings by 4 cents, the stock goes up, but not as much as it would fall if they miss the earnings by 4 cents. That's an asymmetric response. And it's been documented over and over again. Okay, now, all these unexpected portions, though, in the end, they're expected to average 0. And the reason they're expected to average 0 is, let's say that they average to 1%. If they averaged 1%, what we would just do is raise our expectation by 1%, and we'd be back to our unexpected portions averaging 0. Does that make sense? Okay. Now let's talk about systematic and unsystematic risk. So systematic risks, those are risks that influence a large number of assets. For example, what's going on right now in Russia and Ukraine, that is influences a lot of assets. In fact, almost every asset. Now, the next thought is this though, does it impact them all in the same way? So let's think about two companies, an airline, an American airline, not a Russian one, an American airline and an American driller out in West Texas, drilling for oil. That high oil price is going to be good for the oil driller, but it's going to be bad for the airline. And so just because something affects a lot of assets doesn't mean it affects them all in the same way. But it is impacting everything out there. So those are systematic risk. We have another name for systematic risk. We call it market risk. Market risk. And you're going to see this is also called undiversifiable risk. Undiversifiable risk, which is another name for it. And I'll get to that in a little bit. And then we have unsystematic risks. These are things that only affect one or two assets, or maybe a few, a handful. So let's talk about unsystematic risks. What if Walt Disney, their next Marvel, do they do Marvel? Disney? Yeah. What if their next Marvel movie stinks? I'm pretty sure it will. Now, the question is whether people will still go see it. Let's assume that people don't go see it. Is that risk systematic or unsystematic? It's unsystematic. And in fact, if I wanted to own movie studios and I were concerned about such a thing, here's what I would do. I would buy stock in every single one of the movie studios, and usually when one of them has a stinker, let's say Paul Blart Mall Cop 4, someone else has something decent, right? And so when one's up, others down. And so we could diversify that risk away. And that's why we call unsystematic risk diversifiable risk. Unsystematic risk is diversifiable risk. And I'm going to give you a couple of more names for it. We can also call it firm-specific risk, or asset-specific risk, or unique risk, or idiosyncratic risk. Here's your 50-cent word for the day, idiosyncratic. So we have lots of names for each of these. So here's the way I remember it. Systematic risk is undiversifiable, but unsystematic risk is diversifiable. They're opposites, right? So if it is systematic, it's undiversifiable. If it's unsystematic, it's diversifiable. They always are opposite. Any questions so far? Let me give you an example and see if you can figure out whether it's systematic or unsystematic. And this requires a little bit, in fact, Mr. Bohm may have special knowledge here. What about an earthquake in Chile? Am I saying that correctly, Chile? Yeah, okay. Would that be a systematic or unsystematic event?
Systematic.
Systematic, you're right, why?
Because it's going to affect all the assets.
How? Yeah, this is where he's falling short. Anyone have any idea?
The earthquake affects a large area, so it'll affect a large number of the assets?
Not really. So Chile, I don't know if you're familiar with Chile, but it's not really all that big. It's really long and it's thin, but it doesn't have a huge population. It's not overly important in the world economy just because of its GDP or whatever. But it does do one thing very well, and that is produce 35% of the world's copper ore. Copper. If you like your electronic devices, you love copper. Everything electronic that we have has copper in it. If you like turning on the lights at your house, you love copper. If you like cooking a frozen pizza in your electric oven, you'll like copper, right? In fact, we say copper has a PhD in economics because really you can spot what's going to happen with the world economy by watching copper prices. Copper prices are going up, things look good. Copper prices are going down, things look bad. Now, thinking back to it, 35% of the world's copper ore. If those mines get shut down, like they did in the big earthquake that happened a while back, then you end up with only 65% of the remaining supply. What happens to the price then of copper? It shoots up, raises the price of every single electronic device that we buy. Does that make sense? That's how an earthquake in Chile would be systematic, whereas perhaps one in Paraguay would not. What's Paraguay really known for? Anybody know? Yeah, me neither. Okay. Lovely place, I'm sure, but I have no idea how they're important to the world economy. Now let's talk about diversification and portfolio risk. It turns out when you give a finance professor a computer, they can train it to do all sorts of weird things. And so a couple of finance professors trained this computer to go out and 10,000 times in a row select a single stock at random, hold the stock up to the light and say, this is the standard deviation of return for that stock, and then throw it back into the big pool. They did that 10,000 times, and when they did, the annual standard deviation of portfolio returns was 49.24%. In other words, that's the average return for a totally undiverse, or average standard deviation of returns for a totally undiversified portfolio. Totally undiversified, they only own one thing. By the way, that's why Jeff Bezos and Elon Musk want to sell some of their stock. It's not because they don't have faith in their companies, it's because they are totally undiversified. Okay, now the computer's told us that, we say, okay, computer, go out now, and I want you to pick up 2 stocks, and I want you to create portfolios, half of one, half of the other, hold it up to the light, and tell me what is the portfolio standard deviation for, on average, for that 10,000 draws like that. And when we do that, we get now 37.36%. So over in the third column, what we've done is we've divided everything by 49.24%, which means that that top one is 1. It has 100% of the risk. The next one down is only 76%. We have gotten rid of 24% of the risk simply by holding 2 stocks instead of 1. That's your diversification benefit. It's amazing. Okay, now you say, well, wait a minute. If going to 2 got me that much, going to 4 should really do some damage. Well, it takes us from 76% of the risk down to 60%, so we only dropped 16% more. We dropped 24 with the first doubling. We're only dropping 16 with the next. Now, the next one, let's forget 6. Let's double again to 8. We're down to 0.51. So in the third doubling, now we have dropped only 9%. We got 16% for the second doubling, and we got 24% for the first doubling. Do you see what's going on here? As we add stocks, yes, it does reduce the risk, but at a decreasing rate. And the next slide will give you a nice visual for that. Now, looking at this, if we look solely at column number 3, and we ask ourselves the question, how many stocks would I have to be what I would consider well diversified? Well, you look over here and you say, well, down at 1,000 it's 0.39, but it's also 1,000 at 200. So you really only have to have 200 stocks in your portfolio to be well diversified. Does that mean that you're not better diversified at 300? You are, because you go from 19.42 down to 19.34. But the gain is just getting smaller, smaller, smaller. Or I should say the reduction in risk is just getting smaller, smaller, smaller as you add more stuff to the portfolio. Now let's talk about, I'll tell you where I'm at on this whole thing. And let's forget my global stocks. I've got 500 in the S&P 500, and I've got 600 in the S&P 600, so I have at least 1,100 stocks in my portfolio. Am I well diversified? Yeah. Now I have these talks with my dad, and my dad says, how can you keep up with 1,100 stocks? I'm like, well, what do you mean keep up with? He says, yeah, I gotta keep an eye on my stocks. So how many stocks does my dad have? My dad's got about 10 stocks in his portfolio, so he's bearing 49% of the risk, of the total risk. I'm only bearing 39% of the total risk. He also looks at his portfolio every day. I think it's just like a hobby for him, right? But he's looking at the prices of those things every day, And that's why he can only keep up with, say, 10 of them, right? You know how often I look at my portfolio balances?
Once a year.
Once a year. Yeah, we've had this conversation. Once a year. That's what's so darn dangerous about Robinhood, is it's always going, boop, boop. Hey, guess what? Boop, boop. Your Tesla stock is down 2 cents, boop, right? Constantly poking you, prodding you, right? Creating all sorts of anxiety. You don't need that. Okay. Any questions before we move on from this? So here is the same thing, only in graphic, and you can see that diversifiable risk, as we add more and more and more stocks, it just keeps going down, 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 until it becomes what we call asymptotic, which means it's like an airplane coming into land, and every next 100 yards it goes forward, it drops half the distance, half the distance, half the distance, half the distance. It will keep dropping forever, but the amount that it keeps dropping by gets smaller, 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 until it looks like it's actually landed. But in truth, there's a tiny, tiny, tiny space between the wheels and the ground. That's what's going on here. As we add stocks, we can get rid of the overwhelming majority of the diversified risk, to the point where it looks like the only thing that's left is this non-diversifiable risk. By the way, what was another name for non-diversifiable risk? Systematic, non-diversifiable, which we've got up there. Market would be another name for it, right? And that stuff up top is diversifiable risk, also known as unsystematic risk, firm-specific risk, idiosyncratic risk. There's a bunch of names for this stuff. Now, a good test question. By the way, when I say that, your ears should perk up, right? A good test question is, what happens when I add additional stocks to my portfolio? And there are a couple of ways I can word this. The diversifiable risk will go to roughly 0. Or I could say that the total risk will reduce until it roughly equals market risk. The total risk. So basically what we're saying is that total risk, that brown line, is eventually going to become just set right on top of that blue line for the non-diversifiable risk. So there are a couple of ways to say that. Now, the wrong answer is total risk goes to 0, because there is non-diversifiable risk you can never get rid of. Okay, so speaking of total risk and non-diversifiable risk, we have already discussed our measure of total risk. We didn't mention what it was, but standard deviation is our measure of total risk. It contains both the systematic and the unsystematic risk. But the market's only concerned with systematic risk. Let's explain why the market is only concerned with systematic risk. Remember that the price or value of anything is just the present value of the future cash flows discounted at a rate appropriate to the risk. So let's assume that there's an investment out there that's going to pay FV at some point in the future. And there are 2 investors that are going after this. There's me and there's Ms. Hofstetter. Now, I'm an old guy with 1,100 plus stocks in his account. I am well diversified. So what's the only kind of risk that I truly face? I'm well diversified. Ms. Hebb. Yeah, market risk, systematic risk, that's the only risk I face. Now, Ms. Hofstetter is new to investing. This is her very first investment. Is she diversified or undiversified? She's undiversified, so she's having to bear the total risk, whereas I'm only having to bear the systematic risk. Now, we know risk and reward have to go together, so Ms. Hofstetter is going to require a higher return for investing in this than I will, because she has to bear more risk. As a result of her R being higher, she's willing to pay less for the item. Does that make sense? Now, here's the problem. Ms. Hofstetter may not be willing to pay more. But hey, my R is much smaller. I will always win against her in an auction for that good. Does that make sense? For that investment, I will always win because I'm always willing to pay more, because my required return is lower, because I'm bearing less risk. So now, does that mean Ms. Hofstadter can't actually buy this? No, she can go ahead and buy it. She just won't get the return that's commensurate with the risk she's taking, just like my dad. He's not getting a return that's commensurate with the risk that he's taking. But it's me, the diversified investor, who always sets the price in the market. Therefore, the market only rewards the bearing of systematic risk. The market does not care about your unsystematic risk. The market will only reward the bearing of systematic risk. And so that means now we need to have a measure of systematic risk. And the measure that we come up with is beta, which is a Greek letter, beta. So let's talk about how we find this beta for a stock. It's your second line of the day, the characteristic line. What we are doing is plotting the returns on the individual security on the vertical axis and the returns on the market on the horizontal axis. What do we say we use as our stand-in for the market? Say again?
Treasuries.
Oh, that's the risk-free asset. Swing and a miss. Yeah, the S&P 500 is what we're going to use as our stand-in for the market. And so you could have, in fact, I'll demonstrate it to you later. We'll have the S&P 500 as our horizontal axis. We'll have the return on the individual stock as our vertical axis. And then we're going to come up with the slope of that line. Slope, if you're my grandfather, it's rise over run. What does that mean? It's the change in y divided by the change in x. That's slope. The slope of that line turns out to be what we're going to call beta, because this whole characteristic line shows how the stock responds to changes in the market. And remember, we called the systematic risk market risk, right? And so we're only looking at how this thing responds to the market. And so what we can see here is that this has a slope of 1.5. For every 1% increase in the return on the market, we have a 1.5% increase in the return on the stock. So what does that mean? If the market's up 2%, how much is this stock going to be up? What's 2 times 1.5? Oh, you've got to be kidding me. Ms. Herdman. 3, thank you. 3. So if it's down 2%, this thing's going to be down 3%. Now, we've come to a conclusion here. This thing now, the stock, must be riskier than the market, because after all, remember, this is risk, and here's your market, and here's the stock. I'm having trouble keeping them together here, but this is how it works, right? This thing is swinging more than the market. Anything with a beta greater than 1 is riskier than the market. Anything with a beta greater than 1 is riskier than the market. Anything with a beta of 1 is just as risky as the market. Here, let me prove to you the beta of the market is 1. If the market's up 1%, the market's up 1%. All we're doing is really plotting the return on the S&P 500 versus the return on the S&P 500. Of course, it's going to have a slope of 1, because when it's up 1, it's up 1. When it's down 1, it's down 1, right? Then, if it's less than 1, it's safer than the market. If it's less than 1, it's safer than the market. And then we will get into the curious case of negative betas here in a little bit when we talk about the security market line. By the way, this is the second line we've talked about today. The first one was the capital market line. This one's the characteristic line. And we're going to introduce a third one before the day is over. Questions so far? Okay. Let's talk about betas for some selected stocks. American Electric Power. Anybody here familiar with American Electric Power? You got, so anyone from St. Louis here?
Isn't that like one of your utilities companies there? I thought it was American. Yeah, I think it's around there. Anyway, or is that Ameren? I get so confused. Yeah, Ameren. AEP's in Ohio. Thank you. Okay, so basically, what do they make? Electricity. Now, why would making electricity be less risky than the overall market? Let me demonstrate to you. The economy, so here's the logic. When the economy is down, the market is down. And then we're looking at how the stock goes versus the market. Why would American Electric Power not drop as much as the overall market? Here's why. When times are bad, do you think people go home and sit in the dark? No. They might turn the temperature up a little bit on the air conditioner, but they're not going to go home, sit in the dark. They're going to keep, and by the way, water's the same way. They're going to keep flushing the toilet, we hope. Keep taking baths. Except for during pandemic, man, that was sweet. Okay, back to the, yeah, my wife is so glad I'm back in the office every day now. So, my point to you is this, that when times are bad, the electric consumption doesn't go down all that much, especially in the United States, where most of the consumption of electricity is residential versus industrial. If you go to China, most of the consumption of electricity is industrial. And so you'll actually see if they had companies selling electricity, their betas would be higher because industrial production definitely goes up and down with the overall economy. Whew, okay, next one, Johnson & Johnson, what are they known for? Everything, okay, very good. Everything related to what? Do they sell car parts? Yeah, so the baby shampoo, which by the way, that crap doesn't work. I cried every time. Okay, so then what else? So it's like healthcare stuff, right? Now, so do you think in the event of a recession, people are going to stop washing their baby's hair? No. Are they going to stop treating their wounds? No. So that explains why Johnson & Johnson isn't as risky as, say, the overall market. Now, what about Tyson Foods? Tyson, by the way, Tyson's just located directly one state below us, right? You guys did you know that? What is Tyson, what's their big product? Chicken. Chicken is like the big thing. It's how they started. Now, they've recently bought Iowa beef packers, so this analogy isn't quite as true as it used to be. But the idea is this. Chicken versus beef. Which is the cheaper protein? Chicken. And here's why. It takes 4 pounds of feed to put a pound of meat on a chicken. It takes 10 pounds of feed to put a pound of meat on a steer. Steer being a male, yeah, hopefully you guys don't need to know. Well, anyway, so back to the story. Which one of the, so therefore, beef is more expensive. So in bad times, do people say, oh man, I just got a pay cut, let's cook a steak? No. What are they eating? Chicken noodles and chicken ramen noodles. Yeah, sounds like she knows. Okay, so but then let's say when times are good, are you gonna say, ooh, wow, I got a promotion at work, baby, we're going out for chicken? No. And so what we're seeing here is that Tyson they're making a lesser level of good, so they're going to end up not being as moved by the market, and so they're safe. Allstate, what does Allstate do? Insurance, and they're close to market level. Their market, remember, is 1. 3M makes all sorts of stuff. They have a plant here in town. They're really close to the market. And then we start to move into a couple of what we would call tech type firms. Hewlett Packard and Dell, what do they have in common? Computers, right? Now, here's what you need to know about computers. This is why their beta is greater than 1. When times are good, people replace their computers more often. Does that sound like a reasonable? Yeah. When times are bad, now it used to be not true. Computers were advancing very quickly, and your 2-year-old computer was a piece of junk. But now you can keep a computer like 5 years. So if you've got a 3-year-old computer, when the crap hits the fan, you're not going to go out there and replace that thing. And so of course these things are going to have a higher beta than the overall market. Does that make sense? Okay, and then finally, we have the American International Group. Now, here's the deal about the American International Group. It is an insurance company. And so you say, why isn't it more like Allstate? And here's why. In the financial, or prior to the financial crisis, American International Group was writing all sorts of stupid insurance on these subpar bonds that were coming out of the mortgage mess. And so basically, you could bet against these things falling and get a payout from American International Group. Well, when the crap hit the fan and the value of all those bonds fell to near zero, American International Group is in a world of hurt. And if they weren't considered too big to fail, the US government would have just let them explode. Instead, what the US government does is comes in and just gives them enough money to stay alive and takes a huge share of the equity. But what do you think happens to the share price when they announce, oh, we had to make a deal with the government? Right? So then, so the share price is way low at the end of the financial crisis, and then this thing just recovering to its normal levels basically is returning twice the market, not because they're doing such a great job, just because they're returning to normal. Example, if you happen to be president when the economy is recovering from a pandemic, you probably get too much credit because basically what's just happening, the economy's just going back to where it was before, right? Does that make sense? Okay. So if I looked at AIG today, I doubt the beta would be that high. That's just during this period that we were looking at here. Questions? By the way, you can look at beta over different periods of time, 1 year, 5 year, 10 year. And depending on what's been going on, you may see some weird differences between those periods. So how do we calculate beta for a portfolio? If you remember, when we calculated standard deviation for a portfolio, we had to do all sorts of weird stuff with covariances, correlations, and all that kind of crap because we knew there was going to be some diversification. But now we're looking at systematic risk. Beta is a measure of systematic risk. Can you diversify away systematic risk? No! And so as a result, we are going to be left with just the weighted average beta for the portfolio. None of it's going away. Just like you're getting the weighted average of returns, you're going to get the weighted average of beta for the portfolio. So you don't have to worry about covariance, you don't have to worry about correlation. By the way, can you have more? So I've been doing 2 asset portfolios just for the sake of easiness here. Could you have a 3 asset portfolio? Sure. And XA plus XB plus XC would be equal to 1. What if you had a 500 asset portfolio? I won't go through all the letters because we don't have 500 letters. But the point is this, you're going to get to the point where you've got 500 weights. When you add them all together, what should they be equal to? 1. I have 1,100 stocks in my portfolio. When I add all the weights together, what should I get? 1. It's always the same. Now we're going to go on to something called the security market line. I promised you a 3rd line today, and here it is. The security market line. The security market line is a cool tool. It's kind of an outgrowth of the capital asset pricing model. And it says that everything that's fairly priced will show up on this security market line. Now, let's talk about how we come up with this line. Well, we know, and by the way now, we've still got expected return on the vertical axis, but on the horizontal axis now, instead of standard deviation, we have beta. We have beta. And we know that the risk-free asset has a beta of 0. Why? Because beta is a measurement of risk. There's no risk, beta must be 0. And then we also know that the market has a beta of 1. And so that's why that portfolio N is up there at beta of 1. And the return on that, we're going to call it the expected return on the market. Now, we don't have that number we can come up with that number in a number of different ways, usually historical average of the S&P 500, something like that. But then we can just draw a line between those 2 points, and that gives us this security market line. And I can, knowing the beta for anything, tell you what it should be returning. Knowing the beta for anything, I can tell you what it should be returning. Now let's talk about S and T. S and T are below the security market line. That means they are returning less than they should, and so they are overpriced. If they're under the line, they are overpriced. What if something was over the line? It's returning more than the risk would tell you that it should. It is underpriced. So if you're over the line, you're underpriced. If you're under the line, you're overpriced. So it's going to turn out that it's not just stocks that we can do this with. If I can figure out the beta for a project, I can use the security market line to figure out what kind of return that project should require. And we'll get to that in chapter 12. Okay, now let's talk about the equation for the security market line. We can come up with this thing using the slope-intercept form of the line. Do you guys remember the slope-intercept form of a line from algebra? I should just say this. Do you remember anything from algebra? Most likely not. Okay, so here we go. Okay, if you're an American, this is the way you are used to seeing it. Y is equal to mx plus b. If you are Chinese, this is the way you're used to seeing it. Y is equal to ax plus b. Colombia, what do they do? He doesn't remember. He slept that year. Okay, back to the story. Whichever you choose, M or A, this is the slope. We've already talked about slope today, and this is what's called the y-intercept. Now, if we go back to the picture, can anyone tell me what the y-intercept is here? Yeah, it's the risk-free rate. Very good. So this is just going to be the risk-free rate. So now all we have to do is figure out this slope. And so slope is y2 minus y1 divided by x2 minus x1. The question is, what's point number 2 and what's point number 1? Well, let's call point number 1, let's see, 0 and the risk-free rate. And point number 2 will be 1 and the expected return on the market. Now, if you want to sound fancy in front of your friends, these are the Cartesian coordinates. Do you guys remember Cartesian coordinates, x, y? You guys don't remember anything, do you? Where were you when they were having school? Okay, now, back to the story. Now we can figure out the slope. What is the y value of point number 2? Can anyone tell me? Oh my goodness, what comes first, x or y? Very good, the expected return on the market. Can anybody tell me what is the y value for point number 1?
Risk-free rate.
Yeah, the risk-free rate. Now, going down to the bottom, what is the x value for point number 2? 1. And what is the x value for point number 1? 0. By the way, what happens to this thing on the bottom? It's just 1, and when you divide anything by 1, what do you get? That thing, right? And so basically, this ends up being the slope. Now, this is a question that students will see on the exam, and I'll say, what is the slope of the security market line? Students will always say it's beta. Students will always say it's beta. And the reason that they do is because of the traditional way that we write the equation. The way that we write the equation is a little funky. So if you are asked what is the slope of the security market line, it's this thing right here. Oh, by the way, this thing has a name. Remember we said the expected return on anything minus the risk-free rate is that thing's risk premium?
Market risk.
It's the market risk premium. Very good, Mr. Bone. It is the market risk premium. Okay, now let's put it all together. Y would be the expected return on the stock. And then we have the slope, which is the expected return on the market minus the risk-free rate times that x-axis, which is beta, and it's going to be beta of the stock, beta sub I, plus, what's the y-intercept?
It's risk.
Yeah, the risk-free rate. Okay, now we can, so you can rearrange this and put it in this order we have up on here on the screen. But before we do that, let's mess around with it a little bit and see what else we can learn. First of all, what if I subtract the risk-free rate from both sides? Then I have the expected return on the market minus the, or not on the market, on the stock, minus the risk-free rate is equal to the expected return on the market minus the risk-free rate times beta sub I. We know this is the market risk premium. What's this then? What is the expected return on anything minus the risk-free rate? It's the risk premium of that thing. So this is the risk premium of the stock. That's the risk premium of the stock. You can always find the risk premium of the stock simply by taking the market risk premium and multiplying by its beta, by the stock's beta. It makes sense. If the stock is 3 times as risky as the market, that risk premium should be 3 times as high. Now, another manipulation I could do. Beta, I can solve for beta here, and have that it's just simply the risk premium on the stock divided by the market risk premium. So that's another manipulation I can do to this formula. Okay, let's run through some ideas of different betas and see how they affect the expected return. If the beta is greater than, well, let's do a special case here. What if the beta is 0? Then the expected return is just the risk-free rate, right? And that makes perfect sense. If something's not risky, it should return the risk-free rate. What if beta is 1? Well, it's RF plus expected return on the market minus RF. The RFs cancel out and we're left with just the expected return on the market. It makes perfect sense. If something is exactly as risky as the market, it should return the expected return on the market, right? Now, if you go beta as higher than that, you're going to wind up getting more than the expected return on the market. Because of course we discussed why that is. Now let's talk about what happens when you've got a negative beta stock. By the way, let's talk about how a negative beta stock could happen. Some editions of your textbook, it is so funny. The first one that I used gave examples of negative beta stocks. And then the next version says there's no such thing as a negative beta stock. Like, how can that be? Did you learn something new in the meantime? Did the world change? The answer is they were full of crap when they said there's no such thing as a negative beta stock. And here's how I found out. I went home, back then I was an Ameritrade customer, and I used the stock screener. And I just looked for firms with a negative beta. And they were almost all gold mining stocks. Now let's talk about why that might be. During good economic times, people don't necessarily buy gold because gold doesn't create wealth. Let's discuss why gold doesn't create wealth. Hey, here's the example. Buy yourself 2 little gold bars, because I know you've got that kind of scratch lying around. Just buy yourself 2 little gold bars and put them in your safe. You got to put them in the safe because someone will steal them. Put them in the safe and then come back 9 months later and prove to yourself that there aren't a bunch of little gold bars laying around because these two gold bars got together, right? Gold does not create wealth, right? Okay, in fact, it kind of destroys wealth because let's just assume the gold prices stayed the same. You gotta pay someone to store this stuff. You gotta pay someone to sit on it with a shotgun because otherwise someone will take it. Now, back to the story. So what does that mean? It means when the economy is really doing great, people are investing in stocks and things like that, and they're not investing in gold. What happens to the price of gold? It goes down. Demand's down, the price goes down. Now, let's think about what happens during bad times. What do people run to? Yeah, they run to gold, right? And so when they run to gold, what happens to the price on gold? It goes up. Okay, now let's think about the gold mining company. The gold mining company's costs are about the same regardless, right? They got to pay for their diesel, they got to pay for the machines, they got to pay for the people. And so the change in price doesn't really affect their costs. And so what happens is that these increases in gold price, they really juice the profits at these gold miners, right? Because that's the money, that's the cash they're getting for what they dig out of the ground. Now, conversely, during bad times, or during good economic times, the price on what they're digging out is worth less, so their profits are lower. And so what we see is these gold miners move in the opposite direction of the overall market. They tend to be down when the market's up and up when the market's down. Okay, so have I proven to you a philosophical argument here for why we might have a negative beta stock? Okay, so moving on beyond that, what if I put a negative beta up here? It turns out that I'm going to get an expected return that is lower than the risk-free rate. I'm going to get an expected return that is lower than the risk-free rate. Oh my goodness, that just blows your mind. Why would I put up with that kind of bad behavior? Why wouldn't I just buy T-bills? And here's the answer. It has to do with when these stocks pay off. So let's think about this. During good times, you're getting raises at work, you're getting bonuses at work, you've got, your wife hasn't left you, you've still got your pickup truck. It's not country music at all, right? It's all good. Okay, so now think about what it means when your stock portfolio goes up. It probably doesn't mean as much to you because of something we call the diminishing marginal utility of consumption. I'm not even going to write that up, and you don't even have to remember it, but here's the general idea. The more of something you have, the less each additional unit means to you. Example, the year is 1989. My most recent job had paid $3.35 an hour. I am now a college student. I'm hanging out at the dorm with my buddy Derek, and Derek's dad was a big deal civil engineer from Houston, Texas. And he rolls into town, and we were bitterly complaining about having to spend $100 on a textbook. You guys would love to get a textbook for $100, right? We're bitterly complaining about having to spend $100 on a textbook, and he says, $100? I pissed that up against the wall. Now, what does he mean? $100 isn't a big deal to him. My response, please piss my way, right? Okay, now, what are we seeing here? It's the diminishing marginal utility of consumption. Because this man was making $55,000 a year, which at the time was really good money. He's making $55,000 a year, an extra $100 doesn't mean much to him. But me, with my broke-ass $3.35 an hour job, right? $100 means a boatload. Let me give you a more concrete example. You have been wandering in the forest for 3 days. You got lost. Your cell phone battery went dead because you were doing TikTok. Now you can't find your way out, and you're getting really hungry. And on the third day, you emerge from the woods, and I'm standing there, and I'm holding a hot dog. Whoop. Oh my goodness! And I'm wearing a glove. You can tell sanitary. And so the hot dog is smells, looks so good. How much are you willing to pay me for it?
Whatever I've got.
She says whatever she's got. I am not that kind of a person. I'm only going to charge her Walt Disney prices, Walt Disney World prices, $20. So I get you $20, and she eats it. Right? Oh, so good. Is she still hungry? Yeah, she's been in the woods for 3 days. And then, whoop, I develop another hot dog out of nowhere. How much are you going to pay me for this one? Not as much. Why?
Because I've already been satisfied.
You're not in as bad a shape as you were, right? Do you see that each additional hot dog, and at some point she's going to say, no more freaking hot dogs, right? Now, nobody ever does that with money, right? It's like, oh, it's not giving me money, it's driving me crazy. No, the marginal utility of the dollar is always positive, but I'm guessing you guys probably aren't making that much right now. I'm doing okay. It's definitely, the marginal utility of a dollar is definitely higher for you guys than it is for me. Now, have I been in your spot before? Yes. And at that point, when everything just falls apart, when I got laid off from my job, at least that gold mining stock would have been paying great dividends so I could keep eating. It's because those stocks pay off when things are bad, is why we're willing to put up with such bad behavior from them in the rest of the time. Does that make sense? Okay, let's see what else we've got here so we can know. Okay, next time, and you don't need to know this to do your homework, but next time I'll start at and I'll show you how to figure out the beta of a stock using linear regression on Excel. Are there any questions? Okay, see you next time. Okay, so we need to figure out how to calculate beta. And one common way that we do this is through something called linear regression, which I hope you're familiar with from your statistics class. And so what we need in order to be able to do this linear regression is we need returns for the market and we need returns for the stock in question. And so what I've got here is some data. The columns that say GE and SPY were downloaded from Yahoo Finance. You can download historical data. And so GE, that's just General Electric, so that's the share price for every day in 2007 and the last day in 2006. Now, why the last day in 2006? You need that in order to be able to figure out the first return of the year. And I've done the same thing for SPY. Now, what is SPY? Well, it is an exchange-traded fund that is designed to mimic the S&P 500. And the S&P 500, we said, was a proxy for the market portfolio. And so we're using a proxy for a proxy here. And that's going to be our market return. I also have RF, which is the risk-free rate. And I got that from the St. Louis Federal Reserve's website. Okay, now the next step, of course, is to figure the return for each of these stock prices. And so, if I click on the cell here, you'll see that all I've done is taken today's price minus yesterday's price and divide by yesterday's price. And I do the same thing over here for the S&P 500. That's how we get our return. So that's pretty simple. Let's see. Now, think about that security market line equation. It says the expected return on the security is equal to the risk-free rate plus beta times the market risk premium. And so I'm going to make one little change. I'm going to subtract the risk-free rate from both sides. So on the left-hand side, I'm going to have the expected return on the security minus the risk-free rate, which is also known as the market risk premium it's the risk premium for the security. And over on the right-hand side, that just leaves us with beta multiplied by the expected return on the market minus the risk-free rate, which is the market risk premium. Okay. Now, by doing that, we get rid of our y-intercept. Risk-free rate was our y-intercept. And so when we do this regression, the intercept should be 0 or really, really close to it. Now, linear regression, if you've ever done it by hand, is extraordinarily painful. And so we're going to go about this a different way. We're going to let Excel do the work for us. Now, Excel comes out of the box like this. If you go to the Data tab, you'll see there's nothing up here about regression or anything like that. And so what we need to do is load an add-in so that your Excel can do this. And here's how we do that. Go to File, then we go to Options, and we will go to Add-ins. Now don't be fooled, it won't work to click on stuff up here. You have to go down here where it says Manage Excel Add-ins, and I hit Go. And now you want to click Analysis Tool Pack. VBA is a programming language. I don't know what difference it makes. So I'm just going to click Analysis Tool Pack and hit OK. Now notice now that we have Data Analysis up here on our toolbar. I'm just going to go ahead and click that. And I'm going to go through here. There's all sorts of neat stuff that you can play with. Correlation, covariance. But we're going to do regression and hit OK. Now I want to put in the Y range. Remember, Y is expected return on the security minus the risk-free rate. And so all I'm going to do is select all these returns for GE. And when I'm done, it automatically puts them in there. Now I've got to click into the input X range, and I'm going to do all the returns for the S&P 500 minus the risk-free rate, so really the risk premium. And I'm going to do it to a new worksheet. That's fine. I'm going to hit OK. Now, this is a little small, so I'm going to make it bigger for you. First thing you do is go through here and widen these columns out, because for some reason this thing comes out compacted and it's really hard to read these long numbers. And so we'll just go ahead and do that. Okay, so now let's take a look at our numbers here. First of all, R squared is basically it's a measure of how well one piece of data explains another. In this case, how well does the market return explain GE's return? And the R squared here is 0.60. That means that 60% of the variance in General Electric can be explained by the variance in the market. Well, that's pretty good. Now in engineering we would have made fun of an R squared this low. We always wanted 0.95 or 0.96. But in social sciences, which finance is a social science, we end up with much lower R squareds. In fact, I have papers published with R squares below 10%, and they're in good journals too. So this is actually really great for finance type regression. Okay, now we're going to go down here and we've got intercept. So this is the y-intercept, but we said there wasn't going to be a y-intercept. So this thing should be really close to 0, and it is. Now first of all, don't be freaked out by the E05. It's E minus 05. All that means is the number in front of that multiplied by 10 to the negative 5th power. And so all we do is move the decimal point over by the number of by that number of the exponent. And so we wind up with minus 0.00007 and some change. In other words, really close to 0. So that's exactly what we wanted. And we can see over here T-stat, hopefully you remember from statistics, a T-stat that low is not significant. This thing's not significantly different from 0. Now, the other thing that we're interested in is the slope on x variable 1. That coefficient is beta. And for GE, it's showing to be around 0.894. And that matches up really well with some of the historical betas for GE that are given in your textbook. And so we've really done some good work here. It didn't take that much effort, and hopefully in the future you will know how to use Excel for linear regression.